The next presenter is going to be talking about insurance and risk management around recovery residences. I had the opportunity to meet with Lee Goldberg. He did this presentation at the CARR Summit, and it was absolutely fantastic. Lee represents over 20,000 recovery residence beds across the United States, and I believe 6 different NAR affiliates in the state of Colorado. Oh, I'm sorry, 9 different NAR affiliates in the state of across the United States. I'm going to let Lee introduce himself a little bit further, but if we could welcome Lee Goldberg to CARR and to the summit today.
Good morning, everybody. Thank you for the opportunity to be here. I am Lee Goldberg. I'm an independent commercial insurance broker. I have offices in Fort Lauderdale, South Carolina, Georgia, and I live in Asheville, North Carolina. So my mountains are not quite like your mountains, but we like to call them mountains. My house is about half the elevation of where we are right now. So to start off, actually before I start off, I just wanted to say, Butch mentioned the scope in which I work across the country, 20 plus states, 20,000 beds, full spectrum of the substance use treatment space, detox, residential, PHP, IOP, OP, and recovery residences. I work with a lot of state-level affiliates, both directly and indirectly. And Butch asked me to be here. I paid for my flight to be out here, so this has no bearing on any of that. But I wanted to say Colorado is extremely lucky to have somebody who's as engaged and committed as Butch is. It's not like this in every state. It's far from it, frankly. So I just wanted everybody in this room to really understand how lucky you really are to have somebody like him at the helm, assisting and guiding. That being said, further, I wanted to congratulate everybody in this room for really standing out among their peers in this space, not only on a local level, state level, but also on a national level. Being a certified recovery residence operator is really the gold standard. It is the stamp, and you really elevate yourself above your peers who choose not to take on this particular certification. And that being said, I mentioned I work with the full spectrum of the substance use treatment space. And I firmly believe over the 15 years that I've been involved here that long-term recovery really happens in the peer-supported social model environment. So it's important to me to put this slide in here because you guys are really doing the hard work. I'm just a vendor to this space. I don't pretend to be anything more than that. But the hard work really happens at your level, and the long-term recovery really happens at your level. So the change for your state of Colorado is taking place in this room, and I wanted to let you know that I acknowledge that. That being said, if you were at the NAR conference in Dearborn, Michigan about a month ago, these are the same jokes, so I'm sorry. I'm only as creative as I can be. This is insurance. Insurance is boring. I'm not here to tell you that it's anything different than that, but I'm going to make it as exciting as I possibly can. That's my promise to you. It's super important. If you have a question that relates only to you, I will hang out for a little bit after this, and I'm more than happy to engage on a one-on-one basis if it's really on the micro level. But if you have a question that's on the macro level, please throw your hand up. I'd love for you to be engaged. I have a lot of war stories, crazy stories, and if your comment kind of activates one of those stories from the filing cabinet in my head, I'd love to share it with you. I don't want you to miss anything. Again, if I tell a joke, there's only going to be maybe 1 or 2 of them, so I don't want you to miss it because that'll be the highlight of this next hour. And pick someone around you to wake you up. If your eyes start closing, tell them to jab you in the ribs so that you can stay focused here. I am Lee Goldberg for the 3rd or 4th time today. I do insure 20,000 beds in 20 plus states, and I directly assist Florida, South Carolina, Virginia, West Virginia, Pennsylvania, Connecticut, Oklahoma, Colorado, and Washington State. Indirectly, we work a lot with the state of Ohio, but their affiliate is still part of the actual state system. They're not an independent nonprofit at this time. For a number of these states, I assisted in writing the actual state-level requirements for the insurance component of a certified operator, and I've assisted with training the field assessors on how to appropriately read an insurance certificate so they can check the box and leave you guys alone and you can go on with continuing to do what you do. So not all insurance is the same. I'm ignoring you guys over here, I'm sorry, because I feel that screen's closer. Not all insurance is the same. Main Street businesses are easy to insure. Your flower shops, restaurants, perhaps even a plumber, any type of insurance. An insurance agent is really programmed from day one to say yes and to help you in any way that they can. But behavioral health, substance use treatment, recovery residences is not easy. There's a lot of nuance. It's not the same. Your uncle who got insurance for his or her business, their insurance agent might not be the most appropriate individual to help you. And let me take one quick step back and say, this is not a sales presentation. All of this information that I'm giving you today is for you to take back to the insurance relationship that you have chosen on a local level. Educate them. If you feel like you are taking too much time educating your insurance agent on what you do, they might not be the right individual for you. I'm not here to tell you you have to use me. I'm all the way on the East Coast. I certainly have clients in this room. Hopefully they can attest to the service that we provide, but this is certainly not a sales presentation. This is for you to take the information back to them so that they can better assist you on a local level. So not understanding the nuance of any one particular industry is extremely dangerous. So like I was saying, a Main Street insurance policy is not designed for the hazards and risks associated with operating a recovery residence. So having the wrong policy is dangerous. I can look out in this room. I don't know how many people are in here, maybe a few hundred, maybe 200, 300. When you look at your insurance policy, I promise you, you're looking at the top page. And that top page, you're going to make sure your name is spelled right. You're going to see how much it costs, and you're going to just see that you have the right coverage to send off to a NAR affiliate to make sure that you can be a certified resident. The importance of your insurance policy is the next 89 or so pages. And I promise that you're not reading it, and I promise you if you chose to read it, it would be even more boring than the stuff that I'm telling you today. So that's why I'm going to consolidate those 98 pages down to the next couple of minutes here, and that way you have the ammunition. Insurance versus risk management, what's the difference? We like to bundle them together a lot, both within my industry and then just in general speaking. Insurance is the transfer of risk. You're paying someone, the insurance carrier, to take on an exposure for you. You're betting against it. You're betting that if something happens, someone else is going to pay for it. That's called risk transfer. It doesn't prevent the problem. The bad day is still going to happen, and it doesn't necessarily make the problem go away. You're still going to have to deal with the city, the county, the news, the relationships of the families with the other residents in the house. But it covers some or oftentimes most of the cost of the problem. It's paying to make this hit hurt less. The hit's still going to happen, okay? We're talking about insurance here. So for what can be insured, I'm advising you to insure it well, and not everything is insurable. Risk management is about a mile long. Insurance is about a quarter of it. You can mitigate a lot of that through risk management. Insurance is a component of risk management. So for that quarter of that mile, you should be insuring yourself as well as you possibly can so that you can focus on the other 75% of the exposure associated with your business. So risk management, you can finance the risk. You can spend money to avoid it. Once a week, go out and check how much tread is on your tires, on your vans, if you operate vans, and maybe change the tires so you can spend a little bit of money to make sure that your van stays on the road and not upside down in the ditch. You can be proactive. You can review your policies and procedures. You can check your logbook for your sign-in and sign-out procedures. You can make sure that your residents are actually attending the meetings that they say that they're attending. That's proactive rather than reactive. You're making sure it's happening before you have the bad day, and then you go back and check to see if it was actually happening. Prevention. Temperature control on your hot water heater to prevent scalding. They do this in juvenile programs to make sure people aren't burning their hands with the hot water. You can dial back how hot your water actually is. That's a preventative measure. That's an example of that. You can control the risk. You can use insurance. And risk management as a whole is for what cannot be insured. Like I said, that 75% of that mile, that 3/4 of the mile, you use risk management to help bring down and mitigate your risk. You're already risk managers, so I'm not trying to create anxiety. I'm not trying for anybody to lose sleep tonight or for the next couple of weeks. Driving a car, you are managing risk. You are choosing to go the speed limit rather than speed. If you are going to speed, you're choosing to use Waze so you know where a police officer is going to be so you can slow down right before you pass him and then you can speed up again. That is risk management. Asking someone out on a date. They could say no, They could say yes. They could throw water in your face. You're managing that risk and deciding whether or not you're going to do that. Ordering dessert. You're going to have 300 extra calories to burn off tomorrow morning in the gym, but you're choosing to manage that risk on your own. Shopping online. Is it going to be the right size? Is it going to be the wrong size? Am I going to have to box it up and I have to take it back to FedEx? Am I going to have to send it back and then order the additional size? Everything in your, even me. I knew I was coming from a place of humidity to a place with no humidity. I knew the heat was going to be cranking in my hotel room because I was going to be cold last night, and now I can barely move my bottom lip because I didn't bring chapstick. I managed that risk poorly, and then I went to this little shop here in the lobby, and they have everything you could possibly need except chapstick. So I'm going to have to take a 2-stop Uber ride on the way back to the airport. Having children. I have 2 boys, a 12-year-old and a 10-year-old. I am constantly managing risk and managing my risk of not being a helicopter parent to make sure they can go out and make their own mistakes. But man, if I've had broken bones and fights and you guys know. You know how much it is to paint a house if you're not doing it yourself? Hiring a painter, it's way more than it should be, right? You hire a painter to paint your living room and all of a sudden their invoice is 5 numbers on there. It's mind-blowing. And then an iPad goes whipping across the room 2 days later and they have a nice horizontal hole in your brand new painted drywall. I don't know if anyone else, maybe just I'm a bad parent, my kids are crazy. Even going on a walk. I went for a run this morning and there was some ice on the sidewalk, so I was tiptoeing and running like this so that I wouldn't slip. I knew I was going to look silly, but I managed my wrist so I wouldn't break a wrist today. So some examples of risk management. Luckily, you don't have to deal with hurricanes, but I know for a fact you do have some hail events out here in Colorado. So from a catastrophe standpoint, do you have relationships with other people in this room that might be within a 2-hour drive of you? If there was a wildfire, if there was a significant hailstorm or flood, do you have friends with people in this room that could assist in housing some of your residents while your house is being repaired or at least on a temporary basis? I strongly advise you use this opportunity to meet peer programs to say, hey, if I need some beds, can you help me out? If you need some beds, we can help you out. We can be buddies across the state from each other. That is one of the best ways to manage risk. We have a lot of clients in Florida. When last year, when that big storm was coming up and hitting Naples, Fort Myers, Sarasota, Tampa area, I reached out to all of my clients in that area and introduced them to all of my clients in the Atlanta area. It's about a 6-hour drive, but it was enough to get them out. Some people utilized the service, some people didn't, but that's the scenario. Get them away, because you know if the house gets damaged, you're putting stress on an already sensitive population. If you send them home, you're not going to get them back, and then your program is starting like it was when you first started it in the first place. So think about that as a concept, especially here. This is the golden time for everybody here to make those relationships. Or you could have a contract with a hotel. Hey, if I pay you a little bit every month, can you keep 5 rooms open for me? Can you keep it available? Again, I'm telling you about an additional expense. It might not necessarily make sense for your program, but if you are in a wildfire area, this is certainly something to consider. Create a relationship with a local hotel, motel, just so you know that you have beds to keep your residents safe and calm. Alternate location, that's the same thing. Regulatory. This is what Ms. Savage was speaking about. So rental agreements. How are your rental agreements written with your residents? Get an attorney involved in that. New laws, zoning, these are all components you should be aware of so that you can mitigate the risk that might come your way in the future. Financial. So this is tricky because I don't want to speak too much on it because I am certainly not a tax professional. But in certain areas of the country, I don't know if this applies to you here, there is a significant tax implication based on how your rental agreements are written. This has to do a lot with resort areas, so I don't know if any of your properties are up by ski resorts, for example. But if your rental agreements specifically state that it's a week-by-week rental agreement, you're subject to a hospitality tax. So you're paying a high percentage on top of the taxes that you're already paying just for operating a business, okay? Again, it might not apply to you. So the suggestion that I've been told by a CPA is you sit with your CPA and your attorney and you ask them this question, hey, can this impact me? And the solution is you write a rental agreement, a lease agreement with your resident for that bed that exceeds 7 months. You're not going to hold them responsible if they relapse or choose that the program isn't the right fit for you, but at least you mitigate that exposure for the hospitality tax by writing it on a week-by-week basis. Again, not a tax professional. Talk to your tax professionals about that. The economy. If your residents are working in the service industry and we have another pandemic, are they going to have shifts to be able to pay rent? How are you going to manage that? Are you going to, if you're a nonprofit or you have grants lined up to cover those expenses, how are you going to manage scholarship situations if your residents are unable to work? The governmental involvement. This happened in Palm Beach County last year. Palm Beach County came into certain neighborhoods, high net worth neighborhoods, and said that sober homes could not be next door to each other. I had a client with 3 houses on a street, 1, 2, 3. One of the houses had a pool. Everyone could use that one pool. It was a beautiful little compound. They had to sell the middle house because of zoning restrictions. That's an example of managing risk from a governmental involvement perspective. And then transfer. You can buy insurance, transfer some of your risk. Put money in escrow. There's an asset protection strategy that you can utilize. It's a little bit more upstream on the treatment program. But if you get a loan from a lending institution against your receivables, if you were to get sued, those receivables are no longer subject to the lawsuit because they're already owed back to the bank. So that's one way to mitigate some of your exposure there. And also your corporate structure. Are you operating as a sole proprietor, single member LLC, corporation, S Corp, C Corp, nonprofit organization? Those are, again, items you should speak with your attorney about to make sure that you, as a human being that have put all this work in and you've started to accumulate some money, that is protected and completely segregated and separate from that of your operating entity. So, now that I've scared you a bunch, this is a famous saying, at least in my world. A ship is safe in harbor, but that is not what ships are built for. You can get rid of all of these exposures that I just talked about by just going out of business, right? But that's not why you're here. You're here to be the best you can be, to help as many people in the community as you can, and understand that a ship is safe when it's at port. When it goes out in the ocean, when your sober homes are occupied and you're treating the community, that's when the exposure exists. But you can control all of that. All right, this is a history lesson. So if you're a nerd like me and you don't watch Monday Night Football, but you watch the History Channel instead, that's what this part is right here. So the origins of insurance I find to be unbelievably fascinating. And it started in a coffee house on the ports of London. A gentleman by the name of Edward Lloyd had a coffee house. You say, well, in London, didn't they drink tea? Yeah, everyone drank tea. That's why this place was so popular. It was like the first Starbucks of the day, 300 years ago. And now, if you've heard the term Lloyd's of London, which is a global financial institution and primarily an insurer, that's where Lloyd's of London came from. It started in a coffee shop in London hundreds of years ago. And it started off, the reason the coffee shop became a destination, a location for insurance, is because that's where all the merchants would hang out when the colonies were being created in the United States, on the east coast of the United States. So I might be a hat maker in London, and I send out thousands of hats on a ship, and there's no cell phones, there's no email. So I don't know that my hat's made it, and I don't know that I'm getting my money until the ship actually comes back to London months and months later. So all of the merchants would hang out at Edward Lloyd's coffee house, and they would sip coffee, and they would get news because the shipping channels were common. So someone would say, hey, I got Butch's shovels, and they say, hey, I got Lee's hats, and the ships would pass each other, and then they would get the news back at Edward Lloyd's coffee house. And these merchants started thinking, well, what happens if one of my ships go down in a storm? I'm ruined. And the other merchant said, you know, if my ship goes down, I'm ruined. So what do we do? So Edward Lloyd said, you know what, guys? Here's a jar. I'm going to put it on the counter, and you can buy wooden nickels from me. I don't know what the value was, but you can buy a nickel from me. I'm going to put the money in the cash register. I'll put it in the safe. I'll put it in the bank. But that nickel will go in the jar. And we'll just fill up the jar. If you have a few shipments going out and you want to buy a few nickels, go ahead and throw them in the jar. And if somebody's ship goes down, they get the whole jar. And then I'll exchange the wooden nickels for all the money that I collected for them. And that way, together, we can share in the risk. And that's what insurance still is today. It's the sharing in the risk. It's the claims of the few, the premium, the cost, the expense of the many pay the claims of the few. Well, that became so popular, it became just a location on the ports of London, this coffee house, and the wooden nickels didn't make sense anymore. So Edward Lloyd put up a chalkboard, and it wasn't merchants anymore. These were investors. These were people saying like, hey, I know that ship. My father built that ship. It's a strong ship. I'll take the bet that it's going to make it and it's going to make it back. So they started writing up on the chalkboard, Butch's shovels. We would draw a line, and now I'm this rich banker guy, and I'll write my name Lee underneath it. And I say, you pay me $10, and I'll make sure all your stuff is covered if it doesn't make it back. And that's where the term underwriter comes from. because my name was underwritten under Butch's name on the chalkboard. So, little history lesson. I need you to understand where insurance came from and where it is now, and even though it's a little more advanced, it's still the exact same thing. Everybody in this room pays a little bit of premium for their insurance policies, and somebody has a bad day. Cumulatively, that $1 million goes to that person for the bad day, and everybody else starts over. Insurance is just one big bucket of money that everybody shares in. That's the way the system works. So, this is the insurance stuff. This is the stuff you guys deal with every day, or maybe once a year, hopefully not on an everyday basis. But general liability is the core insurance coverage needed, not just for any business, but for your businesses specifically. Feel free to take pictures, but I told Butch he can send this out to anybody if you want it. This presentation is not special. It's for you. General liability is the primary requirement not only of NAR, but of all of the affiliates of NAR. General liability, so to prevent this massive barrier for every sober home operator, that's the core requirement. That's what you need. That's what the field assessor needs to see. This is a commercial insurance policy that provides coverage for bodily injury to a third party arising from your negligence. What does that mean? That means that if somebody gets hurt in the house, general liability pays for it as long as you're negligent. Negligent is somebody fell in the kitchen because the floors are too slippery. Somebody cut their fingers in the kitchen because the knives are too sharp. Or somebody knocked each other's teeth out because there was nobody there to break it up. Okay? Those are just a few examples. If somebody gets hurt in the house, that's what general liability is for. Bodily injury arising from your negligence. I said negligence 2 or 3 times because that's going to come back and play in a very important component in a little bit. Okay? This is not a homeowner's insurance policy. A homeowner's insurance policy is designed for an owner-occupied residence or for a residence of a group of related individuals. This is an argument in the Oxford House model as well as within a few circles. If you can find a homeowner's insurance policy that knows exactly what you're doing in the house and is providing the coverages that you're comfortable with, then take it. In 15 years, I've been unable to find a homeowner's carrier that's willing to do it, even to the point where somebody's purchasing a house, they get a homeowner's policy, they get through the closing table, then the insurance inspection occurs, and the insurance inspector says, there's a group of non-related individuals living in this house. Your policy form is not designed for this exposure. We're canceling you. You have 14 days to replace your policy. That's common. Again, if you can find a homeowner's carrier that you were honest with and told them exactly what you were doing and they're fine with it and the coverage is good, take it. I've never seen it. Some of the common exclusions that I wanted you to be aware of on lesser insurance policies. There's a number of carriers that'll say, we'll insure halfway houses, we'll insure sober homes, we'll insure recovery residences, and then you get a policy and it's $800 for the year, but on that front page it says you have $1 million worth of coverage, but you didn't read the next 89 pages. This is the stuff that's in those next 89 pages. Abuse and molestation, not covered. That's the A and M. A and B, assault and battery, not covered. People get in a fight. If there's an assault and battery exclusion on your policy, there's no coverage for that. I had one guy vacuuming the floor, move somebody's Jordans, fancy sneakers, to vacuum underneath it. One guy didn't like that the other guy touched his sneakers. They grabbed each other's collar and knocked each other's teeth out. PREM, that stands for premises only. A lot of insurance policies limit your coverage to the 4 walls of the address on your policy. Not a big deal as long as nobody ever leaves the house, as long as you never take them to the ball game, grocery store, treatment facilities, 12-step meetings, doing yoga in the backyard. That endorsement's not a problem, as long as you never leave the 4 walls of the house. I don't think that's very common, but I need you to be aware of it. Abuse and molestation is exactly what it sounds like. That's resident on resident, resident on public, public on the resident, staff on resident, resident on staff, doesn't matter. I say, I have an all-men's house, this doesn't matter. I have an all-women's house, this doesn't matter. It matters because this is a common allegation, and it doesn't mean resident on resident only. Something important for you to be aware of. Professional liability, I told you that I said arising from your negligence is going to come back into play, and this is where it comes back into play. Overdoses are not covered by general liability insurance if the family wants to hold you responsible for something that occurs in the house. You are a non-clinical operator. You are not responsible for body checking them, cavity search, checking their bags when they come and go from the house. If somebody's been clean for 6 months, they go to work, they come back, they shoot up in their bedroom, and they don't wake up the next morning, you cannot be considered negligent. Therefore, general liability, the light switch of general liability, is not activated. That policy is not going to respond on your behalf. Professional liability covers you for wrongful acts. Like Ms. Savage said, on your website, on your printed materials, on your brochures, on your email signature, it says we provide a safe, sober living environment. Well, you failed to provide a safe, sober living environment in the eyes of the family, in the eyes of the surviving members of the deceased. Therefore, professional liability is the only remedy to provide defense coverage and to pay damages for an overdose scenario. This also goes for maybe not so much like a level 0 or level 1 house, but 2, 3, and 4. If you're helping with resume writing, if you're making suggestions for career development, if you're helping with college applications for degree completion, if you're making referrals to treatment programs, anything like that, that falls under a professional liability. That is a professional service. You might not be being paid for it. You're doing it to run a great program. However, you are creating an exposure for yourself. This is one of the few subsegments of an industry where the more you do, the more exposure you create. That's absolutely fine. I'm not telling you not to do it. I'm just telling you the way to mitigate that risk is by carrying a professional liability policy. Oftentimes, the best way to do it is for general liability, abuse and molestation, and professional liability to be on a single policy. That way you don't have insurance carriers fighting for 6 months over who's responsible. You can have the deposition, get checks cut, and you can get back to work. You don't need a claim settling situation to consume 8 months of your life. That's the whole reason you're carrying insurance. You paid for it, you punt it, they handle it, the insurance carrier hires the attorneys, you move on with running your program, okay? Now, property insurance, liability is where people get hurt. Property is where stuff gets damaged, okay? If you don't own the building, you still do have property there. You got televisions and pots and pans and sofas and food and toilet paper, consumables and durable goods. So if you don't own the property and you're not in a triple net lease scenario, you don't need to carry building insurance. You can carry property insurance. That's for your stuff. That's when you pick the house up and shake it. Anything that falls out that you paid to have in there, whether it's donated, IKEA furniture, whatever, that's your stuff. Also, if the building burns down or blows away, you could also carry what's called loss of income coverage. If you can't occupy that space and you were getting $150 per week per bed and you have 8 beds and that place is going to be closed for 4 months while you repair it and remediate it and get the water cleaned up and pick up the fire extinguisher foam and whatever, you can carry loss of income coverage. So if you are not an owner of the real estate, you still can carry contents and loss of income coverage, and I highly advise that you do that. That is not a requirement of any regulatory body or anything. That's you protecting yourself and the money that you've invested in your program. Now, it's important because my underwriters always, in the last 12 months, want me to mention this, and this is actually a pretty scary statistic. So this is the engagement time. Can anybody think from a property insurance perspective what the largest segment of claims have been in the last 24 months in sober homes? Does anybody have a guess? What type of damage? Yes, sir. Fire's absolutely right, but even scarier is that 10% of sober homes this year, in the next 12 months, will have a property claim of some kind. 95% of those will be fire. So 1 out of every 10 houses that are represented in this room, according to statistics, I'm not trying to be that weird guy, it's like, you're all going to have a problem. But 1 out of every 10 of the houses that are represented in this room is going to have a property claim this year, and there's a very high likelihood that that's going to be a fire claim. Do you know what the number 1 cause of a fire claim is, according to the 20,000 beds that I insure in the statistics? Cooking, kind of. And it's weird because it's not candles, it's not incense, it's not cigarettes. No, we've had a lot of cigarette issues. After I'm done saying what I'm saying, yell out cigarettes again. I'm going to tell you a story. Yes. Electrical? Not electrical, no. No. But with the vape stuff, the big fancy vape batteries, it could be that, but it's not. Cooking was no, not air fryer. Cooking was the closest guess. No, but it's not cooking food. It's cooking laundry. The number 1 fire loss that we've had in the last 12 months is somebody finished cooking eggs, they go eat, and then I'm done with my laundry and I put my plastic laundry basket there because the kitchen is where the most counter space is so I can lay out and fold my clothes. And then we have melting, cooking, burning, toxic smoke coming from the materials that are inside of all of our clothes now. Putting laundry baskets on top of the cooking grates on a stove is the number 1 fire loss we've experienced in the last 12 months. So, You can choose how to mitigate that risk is by maybe printing a little red sign and saying, no laundry in the kitchen. Anything. It's ridiculous. I'm not here to tell you this is like a science. These are human beings saying, oh, the kitchen has the most counter space. I have a roommate. Their dresser's always flowing everywhere. My bed's a mess. I can't fold my clothes on my bed. So they take the laundry from the kitchen, put the basket on the stove, fire. Dozens of times. Like, it sounds ridiculous. I wish I was making this stuff up. All right, cigarettes. Cigarettes is another really common cause of a fire loss, and it's a very easy way for everyone in here to mitigate it. A glass ashtray on the back porch, if you were anything like I was when I was a smoker, within a week it looks like a blooming onion from Outback. You know, you're trying to find the one empty spot to put it in, because no one wants to empty it out. And when they do empty it out, there's usually one butt smoldering, and then the garbage can catches on fire. I would like all of us to agree that those ashtrays are no longer appropriate. The commercial stanchion ashtrays are fantastic. It's like a bucket of sand with like a tube that comes up with a hole, and you can just drop it in. You don't have to put it out, drop that in. That's a great $100 investment to forget about having to worry about somebody cleaning it out an ashtray. It's just that those commercial stanchions, you can get them on Uline, that thick catalog that you get in the mail. If you were a business owner, I'm sure you get it. You never signed up for it. So that's something to suggest. In Tampa, Florida, I had a recovery residence operator. He's a great guy. I think he formed the first RCO in Florida. Great dude. I still insure him to this day. It's probably been 10 years. They were renting a property that was on the historic registry. In Florida, as you know, there's no basements because everything's wet there. But this was on like a weird crawl space, like without the wall and the little slats. It was just like on really little short like stilts. And it was October, and if you don't know, in Tampa, they actually have these really old trees. They're called live oaks, and they do drop leaves. The ashtray was full. Guy flicked a cigarette in the backyard, landed in a pile of leaves. Typically isn't a problem in Florida. It just happened to be dry that week. The leaves smoldered over a day or two, and a gust of wind came and blew the smoldering leaves underneath the house into the crawl space and burnt the house from the underside up. The landlord was not insured because it was historic property, and he didn't want to carry property insurance on the building, and it held the tenant responsible, and the policy paid because there is a section of your general liability policy that's called fire damage to rented premises. So luckily with the insurance program we had him with, it had $1 million limit on that. $100,000 is not uncommon. If you go back and look at your insurance policies, it's either called fire damage legal liability or damage to rented premises. It's typically $100,000, which is standard. So that's the part of the general liabilities policy that played because they were negligent. They flicked a cigarette in the yard. They didn't make sure that it was stamped out, blew underneath the house, burnt the entire house up. That's a cigarette story. These are some additional oh yeah, sorry. Let me make sure I'm on time because I've been ranting. Okay.
Would you like some chapstick?
Maybe after, yeah. If I'm dripping, just let me know.
No, you're not.
I was in Leadville 4 weeks ago hiking with a buddy, and I didn't get chapped, and now all of a sudden I'm chapped. Yeah.
I was curious. I'm talking to a couple of insurance providers, and they've been telling me that I can't accept participants who have an arson history because they can't insure me.
Yeah.
What are your thoughts?
I think that that's the decision that those insurers made. That's within their guidelines to decide that. I can tell you, again, trying not to be a sales presentation, not all carriers have that requirement or restriction. There are alternatives available for you. Okay? Yeah. But that being said, and in line with Ms. Savage as well, insurance companies are a business just like you are a business. Insurance carriers every year have to file their rates, how much they're willing to charge, and what they're willing to insure with the state that they're doing business in. So in their filing requirements, because it's highly regulated, they could have written in their underwriting guidelines, no arson tenants. And that's fine. You're not being discriminated against. You're not being singled out. That's their guideline.
But they're not technically tenants.
They're your tenants.
No, they're participants in my program.
They're residents of your program.
I don't use the term residents. Clients.
Okay.
See what I mean?
Yeah, no, I see what you mean. But at the end of the day, the whole reason a homeowner's carrier is not appropriate for this, going back to the beginning, is because homeowners insurers have two major requirements, which is why recovery residences, from my opinion and my opinion only, are not appropriate for recovery residences. And that's because a homeowner's policy prohibits a tenant from being a business. So if there's a house and the landlord of the house rents it to an accounting firm, it's not appropriate for it to be insured on a homeowner's policy. The building needs to be insured as a commercial building, even though it looks and smells and acts and walks like a house. The other restriction on a homeowner's policy is that you cannot have transient residents. Transient, and not in the negative term, that's in a term that means it's a group of unrelated individuals, non-family members that can come and go. It's like a boarding house. Homeowners carriers are not insuring dormitories, boarding houses, assisted living facilities. Their definition of all of that is transient residents. Sober homes fall within that scope, okay? So I understand that they're not, we can go in a deep hole on semantics in terms of terminology, but that insurance carrier has said nobody around us can be an arson. At the end of the day, that's the short answer. But there are alternatives. Yes?
Give us some sense of what the insurance or liability should look like for the landlord versus the provider?
Yeah. Yeah, so if you're a landlord for a recovery residence, the physical structure, the first party stuff, the stuff that can burn down or blow away, the house, should be insured on a commercial property policy, and you should have general liability insurance as a landlord. Same thing if you owned a gas station, a strip mall.
Done on a nonprofit basis?
Yeah, same. For this stuff, it's the same whether it's a for-profit or nonprofit. What I see a lot of the time with nonprofits are a very caring, loving individual wants to open up a recovery residence, and it makes the most sense for them and the decisions they made to run the recovery residence as a nonprofit, but they have the money, so they buy the real estate, and the nonprofit pays rent back to the landlord. So they have an LLC that owns the real estate. They lease it to their nonprofit, even though it's them on both sides. It's still entirely separate living, breathing entities with their own federal identification numbers and everything. So the landlord, the LLC of the person who purchased the property, needs to carry a commercial package policy, commercial property insurance, commercial liability insurance, and then lease with the form of a lease and mutual indemnification language, and have your attorney write up a good lease agreement, even though you're signing both of them. And then the tenant should have the appropriate liability insurances and everything for the operation of happens inside. Just think about it this way, because I know this is a ridiculous concept, and us normal people, it just doesn't make sense, right? Think if you owned a strip mall, had four units, 4 tenants. It's a commercial building across the street here with parking and everything, and there was a fortune teller, a gyro shop, a barber shop, and like a shoe repair. If you're the landlord and somebody's shoes don't get repaired appropriately and they trip and fall down a hill, you as the landlord can't possibly be responsible for the operations of the shoe repair shop. If somebody gets food poisoning in the gyro shop, you as the landlord can't possibly be responsible for that, right? So you need to think about the house owner, whether that's you and a separate LLC, and the operating entity, whether that's you or an LLC, as 2 entirely separate entities if that's how you've structured it. The property owner's in the business of leasing property, the operator's in the business of running a sober home. One business is taking place inside of the other business, just like a strip mall, okay? It's very confusing because it's a house. But when we're talking about this, that's the segregation, and that's the way that you need to think about it. Cool? All right. So auto insurance. If you own vans, have a commercial auto policy. Don't put your personal vehicle in the name of the business. Don't have your BMW in the name of ABC Sober Living, please. Because if you let somebody else drive it, they get in an accident, the millions of dollars that you've been saving up over the last decade are now subject to that lawsuit. No human being who owns a vehicle and has a driver's license should be without a personal auto policy. Personal auto insurance is the best stuff you can have. It follows you whether you're a passenger in somebody else's car, whether you're renting a car, whether you're a pedestrian on the street and you get hit with a hit and run. Personal auto insurance is amazing. Keep that. Your accountant's going to tell you, buy the car in the name of the business, we can write off and depreciate. You're creating so much additional risk from a liability perspective. Keep business vehicles in the business name and personal vehicles in the personal name, okay? Now, non-owned auto insurance is really cool. That means it's a coverage that you can add on to your general liability insurance for like sometimes nothing, sometimes a few $100 for the year. And what that does is when you have your house managers transporting residents in their own personal vehicles, and there's an accident, and a resident gets injured or the general public gets injured because your house manager crashed into something in their personal car, and your business gets named in that lawsuit, non-owned auto liability drops down as if you had $1 million worth of coverage on a commercial vehicle, even though you don't own any vehicles in the name of your LLC or your nonprofit, for example. Non-owned auto liability. Think about Domino's. Johnny is a delivery driver for Domino's. He's 16 years old. He works for them 2 hours a week. And they said, Johnny, Mary at 123 Main Street ordered this pizza. We're putting it in your trunk for you. It has to be there in 10 minutes. Johnny said, no problem. I know how to drive. I've been driving for like 6 months. I'm the best. And he blows a minivan off the road at an intersection. Do you think that minivan with a bunch of injured kids and their family, they're going to sue Johnny, who's carrying like $10,000 worth of auto insurance? Or are they going to say, Domino's, you told him to go there and be there, and you told him what to do, and you gave him what to do and what to do with it and all that stuff. We're going to Domino's. That vehicle of Johnny's was a non-owned vehicle of Domino's at that point in time. Same thing if you have staff and you're having a big meeting and you say, hey, go out and grab the sandwiches from the grocery store and bring them back. If they get in an accident, you have a non-owned auto exposure. If you're going to drop cash off at a bank because everyone paid rent on Friday in cash, you're going to do a bank drop, that's a non-owned auto liability at that time. So there's really no excuse, in my opinion, to not have non-owned auto liability on your insurance policy. Everyone needs to go back and email their insurance agent and say, do I have non-owned auto insurance? Can I get it? How much is it? Yes? Even if it's for a 1099 employee? Yeah, even if it's for a 1099. Okay. Yeah. We're going to touch on 1099s in a minute. Butch, I'm running up again. I got 14 minutes and I got a little bit of more content. So you need just start playing the music and I'll thank everyone for the award and then... we're going to talk about it right now, workers' compensation. This is the big argument with 1099s. I was Googling over there because every state has different workers' compensation laws. In the state of Colorado, if you have one employee, you're responsible to carry workers' compensation. Some states it's 4 or more. Some states are 5 or more. Colorado's strict. One employee, you're required to carry work comp, okay? Workers' compensation is almost as good as personal auto insurance. Work comp is the sole remedy, meaning the only remedy for an injured worker. Pays 100% of medical expenses and 2/3 of their lost wages if they're hurt while they're working for you. Okay? One employee, you're responsible. If you don't have workers' compensation, do you know who the insurance company becomes? You. So if you are not in compliance with the state requirements, you're paying somebody and they get hurt while they're working for you, they become your responsibility. You're on the hook for 100% of medical expenses and 2/3 of their lost wages. Now, Lee, I pay everybody as a 1099, so I don't have to do any of this stuff. 1099 is a tax benefit, okay? You're paying them as an independent contractor. If you tell them where to be and when to be there, if you give them the tools and training to do their job and you have the ability to hire them or fire them, do you think a jury's going to look at them as an independent contractor, or do you think it's going to look at them as an employee that you just don't have to pay taxes on? So I believe the answer. The blank stares just means either, Lee, I don't know what the hell you just said, or it means, holy crap, I have like 10 1099s and no workers' compensation insurance. So there's your answer. You can, CAN, carry workers' compensation on 1099s. Paying somebody as a 1099 is a tax benefit. You are not mitigating your liability in the least. A true independent contractor, to give you an example on the other side of the spectrum here, is I have this big, beautiful brick building downtown. I'm going to convert it to an RCO, and Miss Savage helped me get all the approval and zoning and everything for it. And I want an artist to come and paint this awesome mural that reflects my recovery path. Say, hey, it needs to be done in 60 days. You bring your paint. I'm not going to tell you how to do it. Bring a ladder, don't bring a ladder. I don't care. Just have it done. Here's $5,000. That's an independent contractor. That's a true independent contractor right there. If you have a house manager that you're paying with a 1099, and you can fire them, and you say your shift is from 7 a.m. to 4 p.m., they're an employee, okay? This gets even trickier, and I don't want to go down this rabbit hole right now because just frankly we don't have the time, is you have a house manager who you don't pay, but also they don't pay rent. Does that happen in this room? If you're a nonprofit, they can be considered a volunteer. But in court, in laws, when it comes to compensation cases, free rent is considered a form of compensation. Free food is considered a form of compensation. The only thing that's not compensation is hugs and high fives. But if there's anything of value, they're an employee, period, and they can file against workers' compensation with you. So I don't have the cleanest, crispest answer. You might want to talk to your attorneys about this, but a suggestion that I've heard over the past decade or so is if you have a house manager who has higher level responsibilities, they could potentially have a discounted rent, but they're still paying a form of rent. That way, if they are injured, it would fall under the general liability because they are a third party. They're still a resident. Once they don't pay rent at all, and that the reason they're not paying rent is in exchange for the duties that they perform on your behalf in the house, that's compensation even though they don't get a W-2 or a 1099. That's going to be a workers' compensation scenario. And if you are set up that way, you can't even get workers' compensation because there needs to be payroll to get work comp. So you are in a limbo situation there. So I'm not saying you're alone. I'm saying everybody freaking does it. You just need to be aware of your exposure and maybe figure out a way with your team, with your management team, with your attorney about how to clean that up, if it's a concern of yours. I mean, I had a house manager on the 4th of July a couple of years ago go to the 3rd story of this condo building. They controlled the whole building, wanted to set off fireworks for the residents, lit himself on fire, jumped off the roof, broke his back. House manager. I had a house manager arrange an arm wrestling competition in an all men's house. These guys were all like CrossFit juiced up, kind of like me. And they arm wrestling competition, and first match, the house manager got his shoulder ripped out of his socket by one of the residents. Strength. Moving along. Okay, I'll keep going on this stuff. Cyber liability. Listen, you can buy insurance till you're blue in the face and still not have all the coverages that you need come that bad day. Cyber liability is something that is emerging. I feel for it to be important. If you have a really good general liability policy in place, you can usually add like $100,000 worth of cyber coverage for like $300 for the year. Again, if you're set up the right way. Cyber liability, don't think of it as like satellites linking up and hackers coming in. Cyber liability is an old term. Insurance takes a long time to change. Remember, underwriter, we still use that term. That's like 400 years old. Think of it as data breach. Papers could be considered a cyber liability claim. You have a malicious employee that leaves and they take a bunch of residents' names, birthdays, anything with personal and identifiable information, PII, you're federally responsible to notify that person, send them 4 letters, and monitor their credit if you believe that their information's been compromised. And again, this could be from a stack of files that stood up and walked out of your program. Okay? You say, Lee, I keep everything on the cloud, I'm fine. Go ahead and read your cloud agreement. Your cloud agreement with the cloud provider, they're only liable for the amount that you pay them in your form of your, so if you're paying $200 a month to store your stuff on the cloud, they're only responsible for you for $200. Postage alone, stamps keep going down in price, right? No, they go up. Postage alone for a data breach could be $60,000. If you have to mail 4 letters to a couple hundred people, you're looking at $60,000 just on that. 90% of businesses that have had a data breach, big or small, don't recover from it. So you can buy $100,000 of this coverage for like $300. So again, it's not my $300 that I'm telling you to spend. I just need you to be aware of it, and you go and ask the questions to the right people. Employment practices liability. This ties in a little bit to what Ms. Savage was talking about. This is primarily related to employees. This is for wrongful termination, age discrimination and discrimination, sexual orientation, race, religion, whatever. If there's an EEOC allegation that's filed against you, the Equal Employment Opportunity Commission, this is the policy that responds for that on your behalf. Again, sober homes are not historically employee heavy. A lot of owner-operators are involved in the day-to-day. You don't have hundreds of employees. I'm not telling you this isn't important, but the coverage exists. With the right employment practices liability policy, you can also add coverage for what's called third party. That's when you get sued for ADA compliance issues. So the employment practices liability with third-party coverage will defend and indemnify you for some third-party stuff. This was happening in Arizona. Again, I'm in the insurance world, so I can't imagine this information makes it up to you guys. But in Florida and in Arizona, there were 2, I don't want to be politically incorrect, disabled attorneys. They were in wheelchairs. And they would go around to restaurants and public parking lots and grocery stores, convenience stores, and they would just sue them if they didn't have all the ADA stuff in place. So if the ramp wasn't the right length or it wasn't the right pitch, they would file a lawsuit. If I had a client in Florida, it was a tiny little pizza place. It was a friend that I helped them out with their insurance. They had the counter was up here, like it was old school, no seats or anything. You go in, you order the pizza, they hand it over a counter. They didn't have a flip down thing for someone to sign a credit card receipt on. It was like a $12,000 lawsuit. So employment practices liability picks up some of that stuff. Again, it's not a tremendous issue for you guys. I would just want you to be aware of it. Directors and officers is super important, especially if you're a nonprofit. This is when your stakeholders, funding organizations, states, counties, municipalities, regular donors, that when they hold you responsible for the decisions that you make on behalf of the organization, the board. So, okay, say, here, nonprofit, here's a $10,000 check. I would love for you to open a women's house. I know you're an all-men's program. I would love for you to open a women's house. And the board says, yes, $10,000 is really great. We're having a hard time finding a house, but we have to buy a new van. So let's just use this for the van, and then we'll spend the $10,000 on the new house when we can find the real estate. Board gets sued. That's what this policy covers. We can get back to that if you want. All right. I don't like reading right off my slides, but I think this is super important because I wrote it. Not all insurance policies are created equal. If you expect to insure your business the way you intend, it's imperative you adjust your budget to meet the coverage you want and not adjust your coverage to meet your budget. If you buy a cheap insurance policy, that's what you are getting. Listen, that's coming from an insurance agent. My father-in-law says if you go to a barber, he's going to tell you need a haircut. And that's probably mostly true. But at the end of the day, if you're spending $800 a year and you have like 6 houses, read your policy because you're not insured appropriately. You're paying to transfer your risk. You just need to be aware of that. I kind of in conclusion already. I'm available for any questions. I'll hang out for a little bit. I have to leave for like 1 o'clock to catch a flight. But Butch has all of my contact information. My contact info's here. I have some business cards over there. Hopefully I explained insurance in a way that you can understand it because I think it's ridiculous how complicated it is. So hopefully it's kind of brought some light to the subject for everybody. Cool, questions? Standing ovation fund. No, you guys stay seated. Stay seated.
How long have you been in business for, insuring, inpatient, detox, the entire continuum of care?
Yeah, about 15 years.
Okay.
Yeah, the whole reason I got involved in it in the first place is because I was doing, early in my career, I was just trying to figure out what to do, floating around, like anybody in any business, right? I was insuring your plumbers and your flower shops. I had a program for edible arrangements for a little while. I insured a bunch of the franchisees, and that was fun. And then I had a psychologist come to me and say, hey, I'm being subcontracted by this like halfway house, and like they have this insurance and I have this insurance and I don't know if anything's right. I said, you know what, I'll take a look at it. Let me read everything. I found out that every freaking sober home was being treated as like a court-ordered strapped-to-the-bed medical detox facility. And again, that was about 15 years ago. We met with, I don't know if anybody in this room knows much about the East Coast, but there was a gentleman by the name of John Lehman who passed away earlier this year. This man was brilliant, ballsy, and somehow had a death wish because the state of Florida was in such bad shape with so much corruption with recovery resident. One sober home operator was billing $32 million a year in toxicology. That's how Florida was. This guy, John Lehman, he started the Florida Alliance of Recovery Residences, the Florida version of CARR, to clean up the streets. I didn't know how this guy was walking down the street without bodyguards. But he went out and cleaned it up all on his own to make it a better place, a more approachable place, so the family members, the parents, and the loved ones of those who needed to live in a social model environment weren't getting destroyed on their insurance. And he made it a better place. I don't know why I went down this. What was the question? There was a reason. I'm going to get there. Oh, and I was reviewing the strap-to-the-bed medical detox policies, and I said, you know, there's different flavors here. This is an entirely different spectrum. So I went to John, and John approached me at a conference, and he said, Lee, I'd love for you to write an article about sober homes so we can put it on the FAR website. And I said, John, I'll do it. And he said, you're the 4th insurance agent I've come to. And I said, thanks, I really appreciate that. And he said, but nobody's done it, so I did it. and then that's all history from there. But we partnered with AIG, the insurer, and we went and met with their underwriters, and we said, this is not a detox facility, this is not a residential treatment facility, this is not a mental health facility, it's not an assisted living facility, it's this. So basically a sober homes, there was a lot of people involved. I was involved in the early stages, but a sober home that used to cost $10,000 to insure now is like $1,500. Yeah.
Do owners have liability if the clients are going in their own cars and all their clients are going with them?
You're talking about if an owner operator of a recovery residence, you're talking about the liability associated with you, the owner operator, driving one of your residents?
No. If the clients or the residents are driving each other.
No, it's the responsibility of them and their personal auto insurance and making sure. If the residents are driving other residents, the liability is almost none.
Can you go into a little bit of like for the nonprofit and volunteer?
Yeah, so there's a version, and I use that term very loosely, of workers' compensation for nonprofits. If you're an only volunteer staffed organization, you can purchase something for like $300 to $500 for the year called volunteer accident coverage. It's not an infinite policy that pays for everything, but you get a few $100,000 worth of coverage in case your volunteers get hurt while they're working on your behalf. So if you have no staff and no 1099s from a volunteer perspective, you can carry that coverage to take care of your volunteers if they get hurt while they're working for you. If that wasn't your exact question, the additional coverage you should and need to be carrying for a nonprofit is the directors and officers insurance, the D&O. That's to protect your board. The people that are actually volunteering to make decisions for you, you want to protect them because they could be pillars of the community, entrepreneurs, business owners, owners and operators of other programs, and they're dedicating their time to you as a lay leader. You want to make sure you're carrying an insurance policy that's protecting them. That's about $800 a year for $1 million worth of coverage. Yes.
Can we have the tenants get their own individual insurance, kind of like apartments do? Sometimes they have you get your own personal insurance to live there.
Yeah, so you can ask them to get renter's insurance. It's going to provide no upstream coverage for you from a liability standpoint. The only reason I say you could ask them is because their stuff is not covered by anything that you carry. And hopefully you have that in your agreement with them, that you're not responsible for their stuff. If a Louis Vuitton suitcase walks out with 6 iPads in it, no insurance you carry in any form is going to provide that coverage. Your residents are responsible for their stuff. Same goes for their cars. I wanted to circle back on that. If you have 6 cars in the parking lot and they all belong to your residents and a tree falls and crushes all of those cars, you're not responsible for that. They need to be carrying insurance on their own vehicles. If their vehicle's 20 years old and they don't want to carry physical damage, comp and collision, that was a decision they made. Again, if you want to reinforce this in your agreements with them, I strongly advise that you do, but you can't be responsible for the damage to their vehicles. That non-owned auto liability, that's associated with bodily injury. In no way will your policy ever rebuild their car for them. Their stuff is the short answer. Car or otherwise.
So in continuation to
sorry.
that answer, is a hold harmless clause good enough to have in that agreement?
So that's a legal question. I didn't go to school for long enough to really answer that. What I'm saying is if you're implementing some stuff that we talked about today to help be proactive and mitigate future issues, your form of risk management, ask your attorney, take bullet points, call the attorney and say, hey, should we have a mutual indemnification clause? Could we have a hold harmless? I want to say that my residents are responsible for their stuff, and I want to say that their car is their responsibility. And you just want to kind of make that separation. Because it's generational, and I'm 41 years old. I know I'm very young and handsome. But and I think every generation complains about the next generation, but I'm just making a statement here, and that is that it feels that not only your residents, but everybody's residents worldwide the ownership is a big issue right now. And if a tree or a branch were to fall on their car, how could it possibly be their responsibility? Well, it is. If they lost their Apple Watch in their room, who's responsible? It's their responsibility. There's a component of responsibility here, and I think you're trying to teach responsibility and life skills and owning up to things that are your responsibility. But with as litigious the environment is, put it in the agreement just so you have that back end thing. I mean, what's it called? Nuclear verdicts are on a rise. That means any lawsuit that pays out over $10 million. And when you're in front of a jury, it's a jury of your peers, right? There's not a bunch of 41-year-old insurance agents that are my peers that are in there. It's 18 to 26-year-olds who have a problem with everything that I might say. There was a trucking accident, a big rig truck. A guy was over hours, accidentally rear-ended a minivan, and 5 people died, and it was hellacious and horrendous, and it's on the news if you wanted to Google it. From 1980 up until like yesterday, a payout on that type of claim is however much it costs to support the family of the survivors. There were no survivors. It was a husband and wife and their 3 children, and I'm not sugarcoating this. I'm not saying this is a respectable response here. But the jury required the owner of the trucking company to pay out $1.8 billion. Nobody's carrying insurance limits like that. I had a sober home in Fort Myers, Florida, where non-clinical, woman overdosed in the house. She had been in the program about 6 months, was not enrolled in the PHP or IOP associated with this recovery residence, was clean, went out, picked something up, came back, used, didn't wake up the next morning. The family sued for $6 million. Family sued for $6 million because this individual was part of a tribal nation and was receiving reparations of $60,000 a month that was being distributed to all of her family members. The end result was that no money was paid out because it's a non-clinical environment and this individual made that decision on her own, but you need to understand the way families are thinking now. Society has changed. Throwing a little bit of money, making somebody whole, I know I'm coming across very jaded and not respectful here, but if $1 million maybe for somebody who was deceased, there was zero negligence on behalf of the sober home operator in that circumstance. Just because the family was relying on that person to support their family is not the response. That person made a decision. But these are your peers right now. These are the suits that are coming in. And I'm not saying every state or every circumstance is just going to go away. And that's why you transfer the stuff with the things we talked about today.
Lee is going to be here for a little while before he has to fly back home. Let's give Lee a round of applause.
Thank you. You guys do it all. I don't have to.